Hello and welcome. My name is Joe O'Mara. I'm the Head of Aviation Finance with KPMG, and on behalf of KPMG and Airline Economics, I'm delighted to be joined by Mark Streeter. Mark is a Managing Director and the Head of Aviation Credit Risk at JP Morgan. Mark is joining us for the purpose of our Aviation Leaders Report 2024, and I should say we're recording this in mid-October in New York. Mark, thanks a lot for joining us. Before we get into the meat of the conversation, do you want to tell our watchers a little bit about JP Morgan's role in aviation finance?
Sure. I mean, we're very focused on the aircraft leasing channel, first and foremost, right? Our bankers have been very involved. Obviously, they just advised Standard Charter on the sale to Avilease, and on the capital market side, we're very involved in all things lessors in the bond market. We also tend to get very involved in the capital markets when it comes to airline routes, layouts, and gates, secured deals, loyalty deals, and the like. Where we're not really focused on is on the asset-based sort of ABS warehouse lending side. So much more of a capital markets and sort of an M&A banking focus for JP Morgan.
Oh, great, Mark. And maybe we'll start with airline performance. We're in a market where we've seen travel rebound very strongly. Can you talk to us a little bit about how we've seen performance evolve over maybe the last year or so, and your expectations of how that performance will stand up?
Yeah, it's an interesting time in the market right now in October where we're starting to worry about that economic outlook for 2024 and what the events of the Middle East, which just broke obviously the week that we're recording this, what that might mean for the economic outlook. But what I will say is this: if you look domestic US, traffic has fully recovered, well over indexed to 2019. Internationally, we're still lagging, but even just on a global basis, domestic travel has sort of gotten back to that 2019 level. However, global GDP relative to 2019 is still well ahead right now. So specifically, at least 10-15%, and airline traffic should be a multiple of that. So we are not recovered yet to the pre-COVID traffic trend. So a big thing for us when we talk to investors right now is that we're more bullish on the aircraft side of the coin than we are on the airline side. And we're spending a lot of time with investors trying to explain what that actually means, right? Because hold on a second, if you're not bullish on the airlines, how you can be bullish on the aircraft side? Well, it's really a function of just that long-term pull to trend on traffic and what's going on the supply and demand front, on the supply side for aircraft. And how that plays in with, even though we see these headwinds for airlines, we actually think the outlook for the aircraft side of the business is actually stronger.
Yeah, really interesting. So you say we're picking back up, but those lost years shouldn't be lost over the medium term, I guess, from a growth perspective.
Well, remember, traffic is a flow. It's not a store. You don't build it up over time, right? You have to have the airplanes, right, and the aircraft and the service, right, to serve the traffic need that the economies are generating. If anything, right now, traffic probably should have recovered even more so than what we've recovered right now, because we haven't had the aircraft availability to stimulate lower fares and to stimulate more traffic, because there's been the brakes put on the market, right, because of the Boeing and Airbus supply chain issues on their own front, on the airframe front, but then exacerbated, of course, as of late by everything going on with the GTF.
Yeah, and maybe we'll pivot into that on the supply side. How challenging do you think that is? We're looking at, in a functioning market, we have, and let's maybe focus on the leasing market for a moment, with the big guys getting new kit, they're feeding into the secondary market, and things flow. It seems a bit dysfunctional coming off the delays, and maybe we'll park engines for a moment and come back to it.
Well, I think, remember, you have to separate supply and demand, right? So we talked a little bit about the demand side and the fact that global traffic, you can't kill it, right? Whether it's 9/11, SARS, whatever it is, right? We're going to return to trend. Now, granted, I don't want to sound too Pollyannish, because there is a portion of business travel that may never come back, because we're all not going to be in the office 5 days a week, despite what my boss at JP Morgan wants, and mandating certainly senior people at the bank to be in 5 days a week. That's not representative of the rest of the world. The rest of the world may stop at 4 days or 4.5 days or 3.5 days or whatever it is. So there is a business travel component that could be lost forever. I'm sort of skeptical on it, but it could be, right? But what does that mean in terms of leisure and so forth, and what that does to the demand, right? Then you look at the supply side and you go through all these issues that we're talking about on the supply side and how it's constrained. And I think Gus Kelly at AerCap talked about how there's a 5-year bull market for aircraft leasing coming up. There were some conferences in New York this week. The same theme kept coming up. So the setup right now on the aircraft side is probably one of the best I've seen in a while from a supply-demand perspective, if we don't get a shock on the demand side, right? Because we are getting a shock on the supply side.
Yeah, and maybe on that demand side, your thoughts on the macroeconomic outlook. I know again I was at a session this week where pretty stringent views that recession is coming, right, in the US, maybe Q2, Q3 next year, and that the US is potentially positioned better than the rest of the world from a macroeconomic perspective. Your own thoughts on what JP Morgan's outlook is?
Well, our outlook is certainly higher for longer on rates, although if you look at our official forecast, we're still forecasting for the 10-year to come back down 100 basis points over the next year or so. So we're hearing sort of two schools of thought, depending on whether you're looking at our rate forecaster or our economics forecaster. It's not always perfectly synchronized, if you will, in terms of the outlook, but I mean, clearly the market is expecting higher for longer in terms of rates right now, and I think that's what everyone is preparing for. But if you look at the economic outlook for the US and the prospect of a soft landing and so forth, remember that what are we talking about here in terms of just US airlines? The market is so much more than that, right? And we really have to look at where's the growth coming from. And the growth is going to come from Southeast Asia. My friend Adam Pilarski just did a great presentation at the ISTAT conference in London looking at where China traffic is indexed to India right now, and just how it's completely flipped from where it was 30 years ago and how much catching up India needs to do. And that's a whole, of course, another topic of conversation about actually doing deals in India and so forth with aircraft. But we know that there is going to be traffic growth. And that is what everyone in this industry is going to hang its hat on long term. Are those long-term trends? Then we're going to have to get through the nuances of what's going on with the economy, with the recession, with the cycle right now.
And maybe bring it back maybe to the rates piece, right? So as you say, higher for longer, that's our outlook. Maybe focusing on the leasing space, what do you think that means for the medium term for lessors?
It means for the short term to squeeze out margins, because clearly the spot cost of debt, and we're hearing this time and time again, for those that were in London listening to the leasing panels, and by the time people are listening to this, right, we'll probably be in Dublin and people will have an updated view on this, right? But there has been a squeeze on margins, and there is a lag for the flow through, if you will, and it's on multiple fronts, right? It's sort of the undisciplined capital that hasn't had to mark their debt capital to market the same way sort of the Western capital, if you will, has. That capital has still been out there chasing sale-leaseback deals at aggressive lease rate factors, right? So that has to sort of wash out of the market to a degree, and we're starting to see that. And really, probably one of the best anecdotes I can give was Aircastle just had their call, and Doug Winter and I were having a conversation with bond investors about how, for Aircastle at least, 4 out of every 5 lease expiries are in discussion for extension and renewal. That's incredibly important, right? Because that's what's going to turbocharge the IRR calculation, right? If you're a lessor, or you're a one-off owner of an aircraft that's on lease to an airline, to the extent that you can postpone those reconfiguration costs, the transition costs, right? Extend a lease at the then expiring rate. That's what's happening in the market, and that's what's going to help offset the rising cost of debt. And that's why we do have hope that the margin outlook, to your question, over the medium or longer term might actually be better than what we've experienced over the short term because of the squeeze.
Yeah, and you're arguably in a better position if you have assets imminently coming off lease, right? Than maybe a lease encumbered asset. Your perspectives on how that's feeding into values, right? Everything we're talking about here is a supply squeeze. Naturally, that should push values. Is that where we're going?
Well, I mean, look at what Avilease just paid for Standard Chartered, right? I mean, that was a 1.335 times book, on an adjusted basis. Now, Standard Chartered had a conservative book, right? So when you compare that to, say, where the book value perception is on something like an Avalon, where everyone's wondering what the long-term situation there is. I don't necessarily think Avalon's worth 1.35 times book, but I think that was a very good print. You can look at SMBC with Goshawk and what they paid for that. And clearly these platforms have a floor in value or even a premium in value that is higher than if you look at an Air Lease or an AerCap stock, where the market is ascribing that value right now, because there's a lot of fear baked into those stock prices still. about this margin squeeze and what higher funding costs could mean to long-term returns. So I do think, and especially I spend a lot of time with the appraisers board. I've been lucky enough to be involved in that for a long time with ISTAT, and so I talk to a lot of appraisers, and they're all marching values higher. Like current market values are on the way up, right? And that's what's to be expected in an inflationary environment for a hard asset, right? So we have a lot of years where a lot of things went wrong in terms of aircraft values. And now we're starting to see a little bit of catch up with the appraisers, who naturally are always not trying to lead the market, but are trying to observe the market and then sort of react to it. And that's what they're doing right now.
Yeah, you're on this hat on, this is a slight sidebar, but you know, you've got Air Lease and AerCap, and they nearly always trade discounted book, and that discounted book varies, right, depending on market sentiment. Why?
Well, it's a combination. I mean, with AerCap, you've had this sort of constant overhang for years now about the share overhang, right? Whether or not it was old AIG or now GCAS or GE owning those AerCap shares. And that's always sort of put a lid, if you will, a little bit on the AerCap performance. Hopefully that gets worked through over time, and then Gus will do his next deal, and we'll see what happens. But you know, there is hope, and they continue to have a lot of success, even just getting the insurance settlement out of Russia and using those proceeds to further address through a share buyback, right, that overhang. So I do think that overhang over time will go away, and maybe we'll get sort of more pure sort of reflection of how the market is viewing that, absent that technical. You know, Air Lease has always had, they haven't had the overhang, if you will, but Air Lease hasn't been nearly as active in trading aircraft, right? So there's always been a little bit of a concern about, well, how comfortable are investors with the Air Lease book value where they bought aircraft and so forth. Now they're starting to trade aircraft more actively and actually starting to demonstrate that they can book gains in their portfolio. So I think you're going to see a lot more trading from Air Lease, which will sort of support their book value and comfort with that. And then AerCap has always been a big trader and has a huge track record of generating a lot of profits from trading. But as that share overhang is removed, I think people will really start focusing on that as well. And then we have other lessors that are sort of, you know, have a strategy that's based, Joe, on, you know, trading aircraft. Griffin, for example, which issued unsecured bonds, they have a view that they're going to incubate aircraft for a couple of years, trade out of them, book gains, and then plow that money back into their model, right? So we're waiting to see how that works.
Maybe moving to the liability side, can I get your assessment of maybe where the current aviation financing market sits? And you know, we have, it's a broad gamut, right? So we talk about traditional aviation banks, we talk about capital markets, both the big players who can go unsecured, the stalled ABS, and maybe the alt lenders as well, and structured products. I know there's a lot in that question, right? But starting, you know, if you were a lessor now and you're going out on the liability side, how many genuine avenues are open to you, and what's likely to be the most attractive?
Yeah, so right now, obviously the ABS market still really isn't off its back. We're starting, there's an engine lease securitization in the market. And the one thing I will say is people always have these predictions that ABS is dead and so forth. And it's a product, frankly, I don't love, and people know this, right? I just think that it's a higher beta product that's more exposed, that often isn't priced correctly relative to other ways in which to take aviation risk. But I do think the ABS market will come back probably sooner than more people think, and it'll once again be firing on all cylinders, and then something bad will happen again, and it'll go dark, and then it'll come back. It's just, we've been through this so many times. I've seen it over the decades. So, but right now that avenue really isn't there for lessors. But fortunately, they don't really need to use it to trade aircraft that much, because there's still a lot of lessor to lessor trading that's going on that they're funding on their own. And more interestingly now, because of the supply crunch and the limited availability of aircraft, a lot of the airlines are the trading partners for the lessors who are buying aircraft off of lease rather than just extending the lease. They're actually just buying the aircraft. So we're seeing a lot of that as well. And then there is still some private equity out there that has capital that is buying aircraft as well, and, you know, building up a platform or whatever it is, right? Whether it's someone like a Griffin with Bain Capital who's been out there obviously building up a portfolio or whatever it is. So there's capital availability. The capital markets in terms of just issuing unsecured bonds for lessors, it's wide open. It's at all-in yields that they don't love, right? Because the 10-year treasury just recently got close to 5% in the US, but it's wide open. And you know, the same thing for the airlines, right? The airlines can issue WTCs. Everyone's waiting for United to chip away at that $62 billion order book that they have now, post their most recent order. And the WTC market is starving for products. So even though we're in a much higher yield environment, and even though there's a little bit of angst in the marketplace, there's still an ability to get regular way capital market deals done in here.
And your perspective maybe on the alternative lender class, so probably a trend that we've seen accelerate over the last few years, have definitely plugged a gap in the market. Do you think that is a sustainable kind of industry that and one that will grow in the coming years?
I definitely think it'll grow just because private credit and alternative credit is growing across the board. And so in aviation, there are a couple platforms that have been much more active recently. And what I think is really interesting as well is someone like a Castle Lake who has sort of a flexible pool of capital where they don't necessarily just have to invest in metal. Look at the deal Castle Lake just did with SAS, which has just recently broke in the last week or so here. And we're still trying to understand exactly what they're doing there and what their play is there, but they've been involved in some other exit financings and so forth. So I think, and that's one thing when I talk to leasing CEOs, to me, sometimes the best risk-adjusted returns aren't in metal. They're actually in something like an exit financing. I think LATAM is a great example where we were involved in leading that and sold paper at 15% to investors at a discounted dollar price. That's how you got to 15%. And I remember sitting down in a room when that deal was in the market with a bunch of leasing CEOs to say, where would you do a deal with LATAM right now? And pulled the room and it was, okay, lease rate factor of 0.7 something, 8% in change. And I said to them, why aren't you buying LATAM exit financing at 15%? Isn't that better risk-adjusted return? I mean, right now, we'll see what happens by the time this airs, but Morgan Stanley's in the market with an Avalon Holdco deal for this global aircraft leasing company. It's a 14%-ish at the current OID, might even be a little bit higher than that, what's being marketed. That very well may be a better risk-adjusted return than simply doing a metal deal, for example. With whoever it might be in the marketplace. So, and we know that there are some industry players that are starting to sort of rethink what their mandate is and can they be more flexible, right? And it'll be interesting to see how sort of the walls start to fall, if you will, between these different products and how flexible some of these market participants can be.
And on the investor side, I mean, are you seeing any interesting trends in the types of investors that are coming to aviation finance?
I would say the biggest change over the last 10 years was, Joe, I remember, talking to Jerry Latimer, for example, at United about, could he do a $500 million unsecured bond? And we were worried about the capacity in the high yield market. And then COVID came and we did tens of billions of dollars of loyalty debt and route slots and gates backed debt. And the unsecured deals grew and so forth. And you look at what Delta's done on the unsecured side, for example, right? And so the supply of paper, if you will, can often generate demand and can bring new investors into the marketplace. Because aviation in the US capital markets was sort of a niche product for high yield. It became very mainstream because of all the COVID-related financings. So never underestimate sort of the capacity, if you will, of the capital markets in the US to step up if the opportunity is there and the risk-adjusted return is there in the mind of investors. So that's a big, big change. A lot of people think right now, I sort of referred to this earlier, that the WTC market, there hasn't been a lot of supply. I mean, I have spent, I can't tell you how many hours on this, as have the rating agencies and Aviation Working Group, Boeing, Airbus, trying to build up that market. And now, for years now, we've hardly had any supply. But I do think investors do understand that product or can get up to speed very quickly. And I think it's going to be a very big part of what United is going to look to do with that $62 billion order book over time. And I do think that will play a role in how investors look at the marketplace. And then just going back to what we were talking about with ABS, I think the ABS investors are eventually going to get very hungry for product. It's going to be a nature of the LTV and asset type and tweaking the waterfall and all the belts and suspenders around those deals, but that appetite is there as well. So I think that investor appetite for aviation product, it'll ebb and it'll flow, but it on a net basis continues to grow.
And maybe it brings us back to maybe the macro environment for leasing, and you mentioned potentially going into a good market for it where we've got constrained supply. We've seen the percentage of leased assets over time trends one way, generally higher. We saw COVID probably move it up 2 or 3 points, right? You made an interesting point that airlines are buying more aircraft than maybe they had before. They're generating a lot of cash. Where do you see that proportion of leased assets moving?
I think it's going to move higher because here's why. If you're an airline and you just went through the second 100-year flood, right? Really, airlines have probably been through 4 100-year floods in the last 20 years if we count 9/11 and then SARS. That was a mini flood, I guess. 9/11 was a big one. Then you had the GFC, and then you had COVID, and then you can add in Russia from a leasing perspective. That was a 100-year flood, right? But if we just think about it from the airline perspective, what the airlines learned during the COVID experience is that you can't call up capital market bond investors and request a payment holiday, but you can pick up the phone and call Steve Hazy or call Gus Kelly or call whomever it is and say, let's figure out a win-win solution here for both of us. I need some cash flow relief, okay? The last thing you want is me filing bankruptcy and rejecting your airplanes. So, and you have some flexibility on your balance sheet and with your cash flow that I may not have as the more levered airline. So let's work together on a solution. And that level of flexibility and the ability to pick up the phone, I think that's something that is resonating with the C-suites of the airlines, which is permanently, if you will, moved up that percentage of kit that you want to lease so that you have that flexibility in your fleet to do that in a time of crisis. That's one of the things I think I've learned from the COVID experience.
And in keeping with leasing, do you think post-COVID we're in a situation where scale is of more importance than before? Do you need to be, an IG-rated lessor with $6-7 billion of balance sheet to play in a real way?
So I think definitely the trend is for larger lessors at the top of the scale and more rated lessors. That doesn't mean there'll be fewer lessors out there, right? Because think about, even though we've had consolidation at the top and we've had deals like Standard Charter and Avilease, and we've had SMBC and Goshawk, and we've had AirCap and GCAS, and we can go on and on, right? Macquarie with LAFCO, throw that one in there too. We still have all these startup lessors, right? So the number of lessors hasn't changed all that much. If anything, it's grown, but we're going to see more consolidation. And then, look at what Macquarie did with a LAFCO and then decided to pay up and issue 8% bonds, start that process with the rating agencies. Griffin's doing the same thing. Castle Lake has those same goals. Those are 3 platforms, all of which are already sizable, but have big growth ambitions and want to get rated and want to get to that investment grade promised land, right? So that they can compete with AirCap, which is already mid BBB on its way to high BBB and is a top 40 global US dollar issuer now and is going to have a very competitive cost of capital. And at the end of the day, aircraft leasing companies are FinCos and they're spread investors, right? So cost of capital is incredibly important, right? So you want to drive that cost of capital down. I've been doing aviation now for over 20 years. I've been doing real estate finance for over 30 years. Everything that's going on in aviation is following the playbook of what's happened with the real estate investment trust, which is to grow, focus on being investment grade, shifting from secured to unsecured funding, tapping the capital markets. People often ask, why do I do aviation and real estate? And that's one of the reasons. There's a lot of similarities between the two, and they actually take pages from each other's playbook.
So I take your point there, the balance sheet lessors, Mark. If you then think about the asset manager class, I think there's some struggles in that market on the supply side, trying to marry investors and meet their return expectations. Could we see more consolidation across the asset managers?
I think we could see more consolidation across the asset managers. There's been reports that some of the private equity owned asset manager, if you will, leasing platforms, might be for sale. We'll see what happens there. I think going back to my prior answer about how I think some of these asset managers that are involved in the space are trying to figure out if they should become more flexible with their mandate. So not only at Castle Lake, but some of the others that are out there as well. Because I do put Castle Lake under that asset manager umbrella, because ultimately that's sort of their origins and where they started. So, but scale is important, rating is important, having access to the lowest cost capital is important. So that argues for more consolidation.
And maybe just shifting gears on to ESG, where every conference we go to, it's spoken about. I kind of get the sense it's a little bit of lip service some of the time. Is it actually impacting the leasing community at the moment?
So this is something that's near and dear to my heart because I coordinate ESG for our credit group globally, and we spend a lot of time talking about this across sectors and across regions. So there's a couple of things. We're going to continue to see, KPIs, key performance indicator, linked sustainable type funding. I'm trying to think, someone just did one this week. I remember reading about it, but there's going to be more of it. The banks are pushing for it, and you can expect that we'll see more of those types of deals. I do think issuing pure green bonds, if you will, for this sector becomes very, very difficult in terms of what's eligible and what's ineligible. And obviously, even with the EU taxonomy.
Can you have a green aviation bond?
Well, according to the EU taxonomy, in theory, maybe you could because it is eligible. But if you just look at what's been going on with the latest set of rules and so forth, in London, we were literally having discussions, over drinks about how some lessors may need to keep older kit so that they can sort of prove how they're improving, what their path to improvement might be by swapping out of older planes into newer technology. And then if the hand you've been dealt today is all new technology aircraft, how are you going to meet those improvement hurdles that the EU taxonomy is sort of calling for? So a lot of it's not self-intuitive, right? It sort of seems a little bit backwards. But you're also going to continue to see a focus on sustainable aviation fuel, which quite frankly, my personal view is that's a stopgap measure. That's really all the industry can do right now. But there should be much, much more focus on new airframe technology, new engine technology, and really the future of aviation. Because I like to joke that Greta, who just got arrested this week, she's 20 years old. That's how I got the update on how old she is. She's not going anywhere, right? She's going to be around for the next 20, 30, 40 years, right? Leading that sort of climate agenda out of Europe. And there's no getting around the fact that an airplane at 30,000 feet, whether you're running Dinosaur Jet K in the port engine and you have SAF in the starboard side engine, they're still basically emitting the same CO2, never mind the contrail differences that might result from SAF and so forth, which is still under study. So aviation still has an inherent sort of anti-green problem that it needs to deal with. There's nothing wrong with pursuing SAF. I think that's great. I just want to make sure that the industry doesn't take its eye off the ball of what needs to happen long term, which is more efficient airframes, more efficient engines, and really sort of reducing CO2 at the source.
Just in closing, Mark, really interesting stuff, and I really appreciate your time and insights. As you look out over the next 12 months, what are your optimism levels like?
So we're growing increasingly worried about airlining versus aircrafting, going back to my comments earlier. I think the airlines, given higher fuel, potential for soft, hard landing, depending on where we play out in different regions and so forth, interest rates, where they are, student loan repayment in the US, lots of different things. We're already starting to see sort of the low end of the fare spectrum break down a little bit in the US, and that's in a more consolidated market. We know that Europe is less consolidated, so we're watching those trends very closely. EasyJet just came out with a fairly supportive sort of outlook, but we're going to watch what's going on in Europe. Obviously, watching the developments in the Middle East, Southeast Asia, India, in terms of growth there. So there's a lot of different cross currents when it comes to airlines and airline credit quality over the near term. I think on the aircrafting side, we sort of take that longer view, which is focused on supply and demand and how that's playing out. So we're simply just more comfortable there right now. So definitely the worry meter on the airline side is rising, and isn't really rising that much on the aircraft side right now. And check back with me in 3 months and we'll have a different view.
And on that broadly positive note, Mark, I'd like to, on behalf of KPMG and Airline Economics, thank you for your time and insights, and wish you and JP Morgan a very successful 2024.
Thanks, Joe. Appreciate it.